Hi everyone. So now moving on to the next problems, that is next set of problems in capital budgeting. So we have completed nearly 6 to 7 sums in the capital budgeting, which are basic like to get a knowledge about what is this capital budgeting, and those sums they might ask in exams. It's not like they won't ask those kinds of sums in exam. Whereas the here for this capital budgeting chapter, sir has given a separate the material. It has been in this year of academic material. It has been separately given as exam problems. So these exam problems, that is, these give you an idea about how examination will problem will look like. Same concept, same kind of applications. Whereas we'll try to solve these examination problems now, so that you'll get an idea about how an examination capital budgeting problem will look like. Okay, moving on to problem number 14. First we'll read the question and understand the what they have asked us, then we'll move on to the answer. Problem number 14. MN Limited wishes to evaluate two mutually exclusive proposals to acquire a machine. So they want to acquire a machine, that is, they want to purchase a machine. So they are evaluating two mutually exclusive proposals. So machine M and N are being considered, each costing 2 lakh and having estimated life of 5 years and 4 years respectively. So both M and N both costing 2 lakhs, and life of mission M is 5 years and life of mission N is 4 years. Both have nil salvage value, so you won't get back any amount at the end of the disposal of machinery. So the anticipated cash inflows after adjustment of tax, that is the cash inflows after tax they have given. So they have directly given CFAT for M and N are given below. So the anticipated cash inflows after tax for M and N are given below. They have given CFATs for both M and N for the end of all 5 years. That is, at the end of first year, if suppose if you are using mission M, your CFAT will be 70,000. Whereas if you use mission N, your CFAT will be 1 lakh. So these are the different cash inflows after tax for both the mission M and N at the end of 5 years. So they have given all the values for all 5 years, that is CFAT. Next, find the accounting rate of return and NPV, that is net present value, for both the machines, and advise MN Limited which machine should be bought. So clearly understand what they have asked. They have given two machines, that is M and N, which have different life estimates. That is, for machine M 5 years, for machine N 4 years. So if there is difference in life of the machinery, you can't judge the proposals. That is, you can't advise on the basis of net present value. We have seen that in particular problem, that if there is a difference in life disparity of options, then you can't compare the options. Whereas here they have specifically asked to find the net present value. So you should do the net present value in respect of 5 years for machine M and 4 years for machine N. Then below that, find the accounting rate of return and net present value for both the machines, and advise MN Limited which machinery should be bought. The required rate of return is 10% per annum. That is, the cost of capital KO should be taken as 10%. So they have given PV factors for the 10% for 1 to 5 years. So basically what you should find both NPV and the ARR. NPV means net present value, that you can do using CFAT. ARR means accounting rate of return. What is the formula for ARR? ARR is equal to average PAT divided by investment into 100. So here we know what is CFAT. From the CFAT, if you deduct depreciation, you will get PAT. Now reverse working. Normally what we did in previous sums, we calculated what is PAT, that is profit after tax. On that, if we add depreciation, you get CFAT. Here they have clearly mentioned that they have given CFAT. So from the CFAT, if you deduct the depreciation, you will get PAT. So average of PAT. One second. So sorry. So we should do this. We'll continue with this. We are discussing about average rate of, that is accounting rate of return. So formula for this accounting rate of return is average PAT divided by investment into 100. Average PAT can be calculated by adding all the PATs and divided by number of years. So PAT can be calculated here by deducting depreciation from the CFAT. Here they are given CFAT. We know we can find depreciation by dividing the number of years from the total cost. So if you deduct that depreciation, you will get PAT. Average of that is average PAT divided by investment 2 lakhs into 100. If we do, we'll get what is ARR for both the projects. So you should compare using both the projects, NPV and the ARR, and you should tell which is the best option. We should evaluate the options. So that is what asked in the problem number 14. So put the heading. Come to the notes. Put the heading. Problem number 14. Problem number 14. Below that, statement number 1. First we will calculate NPV because they are given CFAT. First we will calculate NPV, then we will go to ARR. Below that, first statement number 1, calculation of NPV. Calculation of NPV. Below that, capital A. NPV of project M. NPV of project M. Below that, 4 columnar table. Below that, 4 columnar table. First column year, second column CFAT, third column PV factor at 10%, fourth column, first column year, second column CFAT, third column PV factor at the rate of 10%, fourth column present value. That is PV, present value. Year, CFAT, PV factor and present value. So first project M we are doing. So calculate. For project M, what is the life of the machinery? 5 years. So in the year column record 1, 2, 3, 4, 5. In the year column record 1, 2, 3, 4, 5. So there are 5 years of the machinery. So what is the CFAT for all 5 years? They have given directly. See, you should always read the question properly. Here they have given the anticipated cash inflows after adjustment of taxes, which means CFAT. So record, copy all the CFATs for each year. For first year, what they have given 70,000. Record in the CFAT column in respect of year 1 record 70,000. Year 2 record 60,000. Year 3 record 60,000. Year 4 record 50,000 and year 5 record 90,000. So CFAT column record 70,000, 60,000, 60,000, 50,000 and 90,000 for all 5 years. So this is the CFAT. So here they have given the required rate of return is 10%. So we should take the PV factor at the rate of 10% for all 5 years. Here in the question itself, they have directly given what is the PV factor at 10% for all 5 years. So copy this. In respect of PV factor at the rate of 10%, record for first year how much they have given 0.909. 0.909. For second year record 0.826. 0.826. Third year 0.751. Third year 0.751. Fourth year 0.683. Fourth year 0.683. Fifth year 0.621. 0.621. So if you multiply CFAT with the PV factor, you will get what is the present values. So multiply it. For year 1, how much it is? 70,000 into 0.909. 70,000 into 0.909. You are getting 63,630. 63,630. That is for first year. Now second year calculated. 60,000 into 0.826. You are getting 49,560. So what is the present value of the 60,000? 49,560. 49,560. For third year also calculate. 60,000 into 0.751. You are getting 45,060. You are getting 45,060. Fourth year record 50,000 into 0.683. 50,000 into 0.683. You are getting 34,150. You are getting 34,150. Next, for last year, that is fifth year record 90,000 into 0.621. What is the present value of 90,000? 55,890. In respect of fifth year record 55,890. So first year is 63,630. Second year 49,560. Third year 45,060. Fourth year 34,150. And fifth year 55,890. So total it. Total the present value column. Total the present value column. How much you are getting? You are getting 2,48,290. Now below the present value column, underline it, record, total it and underline it, record 2,48,290. So what is this 2,48,290? It is nothing but present value of cash inflows. So you are just converting the CFAT into present value of cash inflows. So in respect of the 2,48,290, record present value of cash inflow. Present value of cash inflow. Below that less present value of cash outflow, less present value of cash outflow. Below that, open a bracket. Next to that present value of cash outflow, open a bracket. How much is the cash outflow? 2 lakhs is the total cost of machinery. So next to that present value of cash outflow, open a bracket. 2 lakhs into what is the present value factor of year 0, 1. So 2 lakh into 1. 2 lakh into 1, close the bracket. In respect of present value column, record within bracket 2 lakhs. In respect of present value column, record within bracket 2 lakhs. So present value of cash outflow is 2 lakhs. Record within bracket 2 lakhs. Now total it. Now total the present value column. 2,48,290 minus 2 lakhs. You are getting 48,290. Below that, total it. Record 48,290. So what is this 48,290? It is nothing but NPV. Present value of cash inflow minus present value of cash outflow is nothing but net present value. So we are calculating in respect of that 48,290, record NPV. Therefore NPV, that is net present value. What we should do is, they have given CFAT, we should convert it into present value of cash inflows, then we should total it. From that you should deduct the present value of cash outflow, that is mission cost. We are getting NPV of 48,290. NPV of 48,290. So below that, leave one line gap, record capital B. Leave one line and record capital B. NPV of project N. NPV of project N. So below that, 4 columnar table. Below that 4 columnar table, first column year, second column CFAT, third column PV factor, and fourth column present values. PV. First column year, second column CFAT, again same calculation, you should repeat it. First column year, second column CFAT, third column PV factor, and fourth column present value. So see, NPV of number of years of project M is 5 years, whereas project N is 4 years. They have given 5 years and 4 years respectively, which means M 5 years and N 4 years. So mission N has only 4 years of CFAT. So record below that years, record 1, 2, 3, 4. Record 4 rows. In respect of each row, record year 1, year 2, year 3, and year 4. In respect of year 1, what is the CFAT for year 1 for mission N? 1 lakh rupees. So in respect of CFAT, year 1 record 1 lakh. Year 2 record 90,000. Year 3 record 80,000. Year 4 record 40,000. 1 lakh, 90,000, 80,000 and 40,000 CFAT. We are just copying it from the question. So after that, what is the present value factor at the rate of 10%? For both the projects, the required rate of return is 10%. So here there are only 4 years. So copy only 4 years present value factors. Present value factor for the year 1, how much? 0.909. Copy 0.909 for the year 1. 0.909, and for year 2 0.826, 0.826, for year 3 0.751, and for year 4 0.61683, and for year 4 0.683. Now we have calculated what is, we have just copied the values, that is what CFAT they have given for mission N, we have copied that, and for what PV factor what they have given for all 4 years at the rate of 10%, we have copied. Now if you multiply CFAT into PV factor, you will get what is the present value of cash for every year. Present value of cash inflow for every year. So now multiply it. 1 lakh into 0.909. 1 lakh into 0.909, you are getting 90,900. So in respect of present value column, year 1 record 90,900. 90,900. So in respect of year 2 record 90,000 into 0.826, you are getting 74,340. 74,340. 74,340. And in respect of year 3, how much is the year 3 CFAT? 80,000. If you multiply with the PV factor 0.751, you are getting 60,080. 60,080. Record in the present value column for year 3 60,080. And for the 4th year, that is the last year, what is the CFAT? 40,000. And if you multiply it with the present value factor, that is 0.683, you are getting 27,320. So in respect of present value column, record 27,320. 27,320. So now total it. Present value column, total it 90,900 plus 74,340 plus 60,080 plus 27,320. You are getting Now PV column total, you are getting 2,52,640. 2,52,640. Present value column total, underline it. Below that record 2,52,640. In respect of the 2,52,640 record present value of cash inflow. Therefore, present value of cash inflow, that is 2,52,640. Below that present value of cash inflow record less present value of cash outflow. Present value of cash outflow. Next to that present value of cash outflow, just open a small bracket. Out, what is the machine cost of machine N? 2 lakhs. So 2 lakhs spent at the year 0, that is today, will be 2 lakhs into 1. So present value factor of year 0 is 1 for all the different percentages. For 10%, present value factor at the rate of 10%. For year 0 is 1. So within bracket 2 lakh into 1. Within bracket 2 lakh into 1. Now record in respect of present value column. In respect of present value column, record within bracket 2 lakh rupees, because you should deduct this 2 lakh from this cash inflow. So within bracket 2 lakh rupees, that is the present value of cash outflow. Now total it. Present value column, total it. 2,52,640 minus 2 lakhs. You are getting 52,640. You are getting 52,640. In respect of that 52,640, record net present value. In respect of that 52,640, record net present value. Net present value. So we have found net present value for both the machines. That is, for machine M it is 48,290 and for machine N it is 52,640. So comparatively NPV of the project N is higher. Comment, we will write it later. Now record. So this is the NPV. First we have calculated what is the NPV. They have asked us both NPV and ARR. We have finished NPV. So now calculate what is ARR. Below that, leave a line gap. Record statement number 2. Statement number 2, calculation of ARR. Calculation of ARR, that is accounting rate of return. Below that capital A. Below that capital A, accounting rate of return of project M. Accounting rate of return of project M. First we will calculate for project M, then we will go for project N. Now ARR for project M. Below that, see, if CFAT is same for all the years, we can do it in the one column itself. But here CFAT is different for all the years. So for all the CFAT, you want to add depreciation so that you will get what is the PAT for all the years. So below that, 6 columnar table. Below that ARR of project M, 6 columnar table. First column particulars. Second column year 1. Then year 2, year 3, year 4 and year 5. Particulars year 1, year 2, year 3, year 4 and year 5. So below that particulars, record CFAT. CFAT. Copy the CFAT. What they have given CFAT for all 5 years for machine M, just copy it. 70,000 for year 1, 60,000 for year 2, 60,000 for year 3, 50,000 for year 4 and 90,000 for year 5. That is 70,000, 60,000, 60,000, 50,000 and 90,000. So that is the CFAT, cash flow after tax. That is cash flow after tax. So we have got what is the CFAT for, they itself have given what is the CFAT for machine M. Simple. What is profit after tax? Profit after tax can be derived by 2 ways. One is profit before tax minus tax, you will get profit after tax. After that, if you add depreciation, you will get CFAT. Now reverse working. We know what is CFAT, we know what is depreciation. So CFAT minus depreciation, you will get profit after tax. On that, if you add tax, you will get what is PBT. So this is called reverse working. Here they have given a CFAT. Now do the reverse working. CFAT minus depreciation, you will get profit after tax. So record. Below that, less depreciation. Because accounting rate of return, we should do always with PAT. You can't do with CFAT. Just remember, only for the accounting rate of return, you need PAT. For every other thing, net present value, NPV, you need CFAT. For profitability index, also CFAT. For IRR, also CFAT. For every other budgeting technique, capital budgeting technique, you need CFAT. Whereas for accounting rate of return, you need always profit after tax, PAT. So for here they have asked us to calculate accounting rate of return. So here we should find what is PAT. So below the CFAT record, less depreciation. Less depreciation. What is the depreciation for machine M? It costs 2 lakh rupees and total number of life of years is 5 years. They have given the estimated life of 5 years and 4 years respectively, which means M is 5 years, N is 4 years. So 2 lakhs divided by 5 is the depreciation for each year, because there is no salvage value. 2 lakhs minus 0 divided by 5, that is 40,000 every year. So in respect of all the years, record 40,000. How did we get this 40,000? Cost of machinery is 2 lakhs, life of machinery is 5 years. So 2 lakh divided by 5 is 40,000. So 40,000 every year. So in respect of all the years, record 40,000 within bracket. In respect of all the years, record 40,000 within bracket. 40,000 within bracket. Now if you deduct it, below that particular column, below that record PAT, that is profit after tax, PAT. So CFAT minus depreciation is PAT. So now for each year calculated, 70,000 minus 40,000, you are getting 30,000. So in respect of year 1, record 30,000. For year 2, 60,000 minus 40,000, you are getting 20,000. For year 3, 60,000 minus 40,000, you are getting 20,000. For year 4, you are getting 50,000 minus 40,000, that is 10,000. 50,000 minus 40,000, that is 10,000. And for year 5, 90,000 minus 40,000, you are getting 50,000. 90,000 minus 40,000, you are getting 50,000. So profit after tax for all the 5 years we have calculated, that is 30,000, 20,000, 20,000, 10,000 and 50,000. So now if you add all 5 profit after tax and divide it by 5, you will get what is average profit after tax. So just add it. 30,000 plus 20,000 plus 20,000 plus 10,000 plus 50,000 divided by 5, you are getting 26,000. So below that, record the formula for ARR. Below the PAT, leave a line gap. Now record the formula. ARR is equal to average PAT divided by average. We can take both. We can either take average investment or we can take initial investment also. So here average PAT divided by average investment they have taken. So average PAT divided by average investment is equal to, what is the average PAT? Addition of summation of all the PATs divided by 5. So total of all the PAT is 1,30,000. So within bracket record equal to, within bracket record 1,30,000 divided by 5, close the bracket. 1,30,000 divided by 5, close the bracket, whole divided by, what is the average investment? The cost of machinery at the opening is 2 lakhs plus what is the closing investment? 0. So 2 lakh plus 0 divided by 2. We can go with normal initial investment only. This average investment will be little confusing. So just change this average investment into initial investment itself. Average PAT into average PAT divided by initial investment. So how much is the initial investment? 2 lakh rupees. So 1,30,000 divided by 5, whole divided by 2 lakh. Just take it as 2 lakh. 2 lakh. So what is 1,30,000 divided by 5? 26,000. So 26,000 divided by 2 lakh, you are getting 13%. So is equal to 13%. Is equal to 13%. So ARR for project M is 13%. So now we should calculate ARR for project N. Now record. Below that, capital B, leave a line gap, capital B, ARR of machine N. ARR of machine N. And below that 5 columnar table. Below that 5 columnar table, first column particulars, don't use this format, just go with the previous format itself, how we did for machine M. 4 columnar table, first column particulars, second column year 1, third column year 2, fourth column year 3 and last column year 4. So machine N, life of the machine is only 4 years. So only 4 years. Year 1, year 2, year 3 and year 4. Particulars year 1, year 2, year 3 and year 4. So below the particulars record small a CFAT. Same thing you should do. CFAT minus depreciation, you will get PAT. Average of PAT divided by initial investment, you will get what is the ARR. So first, what is CFAT? Copy all the CFATs for the all 4 years. Year 1 record 1 lakh. Year 2 record 90,000. Year 3 record 80,000. And year 4 record 40,000. 1 lakh, 90,000, 80,000 and 40,000. 1 lakh, 90,000, 80,000 and 40,000. So below that small b, less depreciation. What is the depreciation value? Cost of both the machine is 2 lakh only. So 2 lakhs divided by number of years is, for N is 4 years. So 2 lakh divided by 4, that is 50,000. So below that, small b minus depreciation in respect of all the years, record 50,000 within bracket. 50,000 within bracket. 50,000 within bracket. So below that, small c. Below that, small c. Profit after tax. Within bracket a minus b. Small c, profit after tax. Within bracket a minus b. So totally deduct the a minus b for all the 4 years. So for year 1 it is 1 lakh minus 50,000. You are getting 50,000. You are getting 50,000. Year 2 90,000 minus 50,000. You are getting 40,000. 40,000. Sorry, I just paused the video. Okay, we'll resume it. Profit after tax. We found what is profit after tax for all the years. That is for year 1 1 lakh minus 50,000. 50,000. For year 2 80,000. 90,000 minus 50,000. You are getting 40,000. For year 3 80,000 minus 50,000. You are getting 30,000. And for year 4 40,000 minus 50,000. You are getting within bracket 10,000. That is negative of 10,000. So that is the profit after tax for the machine N. So what is ARR formula? Average profit after tax divided by initial investment into 100. So below that, leave one line gap, take down the formula. Don't use this format. It's suggestible to use this old format itself. This ARR formula, average PAT divided by initial investment into 100. So below that, take down. ARR is equal to average PAT divided by initial investment into 100. Average PAT divided by initial investment into 100. So see, average PAT is summation of all the PAT values divided by number of years. Here PAT values are 50,000, 40,000, 20,000 minus 10,000. So if you add everything, you will get 1 lakh 50,000 plus 40,000 plus 20,000 minus 50,000 plus 40,000 plus 30,000 minus 10,000. You are getting 1 lakh 10,000. So in respect of that average PAT record, 1 lakh 10,000 divided by how many number of years is the life of the machine? 4. So 1 lakh 10,000 divided by 4 whole divided by what is the initial investment? 2 lakh. So 1 lakh 10,000 divided by 4 whole divided by 2 lakhs into 100. So we are going with initial investment. We are not going with average investment. So below that formula, record 1 lakh 10,000 divided by 4 whole divided by 2 lakhs into 100. So what is 1 lakh 10,000 divided by 4? You are getting 27,500 divided by 2 lakhs into 100. You are getting 13.75. So below that is equal to ARR is equal to 13.75%. 13.75%. Here for mission N ARR is 13.75 and mission M ARR is 13. So comparatively ARR of mission N is higher. So below that record comment. ARR of mission N is comparatively higher. Hence it is advisable to select mission N. ARR of mission N is comparatively higher. Hence it is advisable to select mission N. Full stop. See, here we commented only on the basis of ARR, but we didn't comment on the basis of NPV because there is life disparity. We calculated NPV. They asked us find out NPV, they told. So we calculated NPV, whereas we didn't comment on NPV because NPV is not the technique if there is life disparity. If there is life disparity between options, if there is 2 different options having 2 different lifetime of the life of the project, then NPV cannot be used as a capital budgeting technique to evaluate the options. So we are commenting only using ARR. That's it. Very simple. But ARR can be used if there is same investment amount. Here investment amount for both the options are 2 lakh rupees. So you can use ARR to comment. So that is called ARR and NPV. That is problem number 14. With this we have completed problem number 14. So then moving on to next problem, that is problem number 16. Moving on to next problem, that is problem number 16. First we'll read the question. FB Chemical Limited. See, I'm not giving gap between two videos, that is two sums in the video. But if you are watching the video continuously, you just pause the video once a problem is completed, then just go through what is there in that particular problem, so that it will be easy for you to understand it when you are when you are seeing the classes itself. See, usually in offline classes, that is in offline classes, like every 2 or 3 problems, there will be a 5 minutes or 10 minutes a gap where you can understand where you can use the time to understand the problem, what they have taught, what is the concept that has been used. You can use that time. Whereas now in this like in online videos, we are continuously going through every other problem. We are not wasting the time. So you just pause the video, use the time to understand what has been solved in the previous problem, then start the video and watch the next problem. So that is how you should that is my suggestion. So you can do that. So next is problem number 16. FB Chemical Limited has 3 potential projects, all with an initial investment cost of 20 lakh and estimated life of 5 years. So all 3 projects initial cost is 20 lakhs, that is cash outflow is 20 lakhs, and the estimated life is 5 years. The capital budget for the year will only allow the company to accept one of the 3 projects. So you can only select one of the 3 projects given the discount rates and the future cash flow of each project. See, they have given what is the discount rate and the future cash flow of each project. So which project should company accept? Simple. The life of the machinery is 5 years. So you can use the NPV to comment on the project. So simple. Very easy problem. You can solve it by using the NPV technique and find which is the best alternative among all 3 projects. So we'll go one by one project. See, project 1, which project should the company accept? Project 1 has an annual cash flow of 5 lakhs at discounted rate is 6%. So 5 lakh is the annual cash flow and discounted rate is 6%. So at 6%, what is the NPV, present value factors? You should multiply with the 5 lakhs. And project 2, again 6 lakhs. 6 lakh is the annual cash flow. That is for every year it is 6 lakh for 5 years. Then discounted rate is 9%. And for project 3, the cash flows are different for every year. They have given different cash flows for every year and discounted rate is 15%. So you should use this annual cash flow and the present value factors so that you can find the net present value of all 3 projects and compare all 3 net present value. Whichever is higher should be accepted. So moving on to the solution. Problem number 16. Statement number 1. Calculation of net present value of project 1. Calculation of net present value of project 1. Below the 3 columnar table, first column particulars, second column amount, and third column also amount. First column particulars, second column amount, and third column also amount. See here, if there is same annual cash flows for all the 5 years, then you can multiply with the annuity factor for 5 years at the given percentage, at the given rate, so that you will get what is the total present value of cash inflow. You don't have to do for every 5 years, every year separately. Total number of years is 5, and for all 5 years annual cash flow is same, that is 5 lakhs. So 5 lakhs into annuity factor of 6% for 5 years. You can easily get what is the present value of cash inflow. From that, if you deduct the present value of cash outflow of 20 lakhs, you will get NPV. So below that particulars, amount, 3 columnar table, particulars, amount and amount. Below that particular small a, present value of cash inflow. Below that small Roman number 1, annual CFAT. Small Roman number 1, annual CFAT. They have given annual CFAT cash inflow after taxes 5 lakh rupees. So in respect of inner amount column, record 5 lakhs. In respect of annual CFAT, inner amount column, record 5 lakhs. Below that small Roman number 2, what is the discounted rate they have given? 6%. So at 6%, what is the annuity factor for 5 years we should calculate? Come to values, that is page number 247. 247. So in this, at 6% discounted rate for 5 years, what is the annuity rate we should find? So 6% year, 6%, and that 5 years. So annuity rate for 6% 5 years is 4.212. So in respect of annuity factor, in respect of the statement number point number 2, that is small Roman number 2, annuity factor at 6% for 5 years. at 6% for 5 years. So how much is the value? 6% for 5 years, 4.212. So in respect of inner amount column record 4.212. 4.212. Below that, leave one line gap and underline it. Leave one line gap and underline it. How much is the value? 5 lakh into 4.312. 4.212. You are getting 21 lakh 6,000. So in respect of outer amount column record 21 lakh 6,000. Total it outer amount column record 21 lakh 6,000. 21 lakh 6,000. So in respect of the 21 lakh 6,000 record small Roman number 3, present value of cash inflow. Present value of cash inflow. Present value of cash inflow. Within bracket small Roman number 1 into small Roman number 2. Within bracket small Roman number 1 into small Roman number 2. Now below that small b. Below that small b. What is present value of cash outflow given in the question? 20 lakhs for all the projects. So below that small b, present value of cash outflow. Present value of cash outflow. Next to that present value of cash outflow itself, open a bracket. How much is the total cash outflow? 20 lakhs. When it is spent? Year 0, that is today. So year 0 value of present value factor is 1. So 20 lakhs into 1. Within bracket 20 lakhs into 1. Within bracket 20 lakhs into 1. Now close the bracket. Outer amount column record 20 lakhs within bracket. In respect of the present value of cash outflow, outer amount column record 20 lakhs within bracket. 20 lakhs. So now outer amount column total it. 21 lakh 6,000 minus 20 lakhs. 21 lakh 6,000 minus 20 lakhs. You are getting 1 lakh 6,000. So total it. Underline it. Below that put 1 lakh 6,000. So in respect of that 1 lakh 6,000 record small c net present value. Small c net present value. So we have found what is the net present value for project 1, that is 1 lakh 6,000. Now repeat the same thing for project 2. What was the page number? 204, yes. No, 205. Okay. So using that annual cash flow after tax and discounted rate, we found what is the project 1 NPV. So repeat the same thing for project 2. Below that statement number 2. Below that statement number 2. Calculation of NPV of project 2. Calculation of NPV of project 2. Below that 3 columnar table. Below that 3 columnar table. First column particulars, second column amount and third column also amount. First column particulars, second column amount and third column also amount. Below that particulars record capital A, or else record small Roman number 1. Small Roman number 1. Annual CFAT. Annual CFAT. Outer amount column itself record 6 lakh. See here in project 2 they have given annual cash flow is 6 lakh and discounted rate is 9%. So annual CFAT outer amount column itself record 6 lakh. Outer amount column itself record 6 lakh. Below that small Roman number 2. So discounted rate is 9%. So small Roman number 2 annuity factor for all 5 years we are calculating put together. So annuity factor at the rate of 9% for 5 years. AF, that is annuity factor at the rate of 9% for 5 years. So calculate the value. What is the annuity factor at the rate of 9% for 5 years? Annuity factor at the rate of 9% for 5 years. See 9% for 5 years. What is the annuity factor? 3.890. So record it. Outer amount column itself record in respect of that annuity factor at the rate of 9% for 3 years. 3.890. 3.890. Now underline it. Below that 3.890, underline it. Now multiply it. Below that underline it. Below that record in respect of particulars column small a present value of cash inflow. Present value of cash inflow. Present value of cash inflow. So what is the next to that present value of cash inflow within bracket record small Roman number 1 into small Roman number 2. Small Roman number 1 into small Roman number 2. So you are getting 23 in respect of that present value of cash inflow. Outer amount column record 23 lakh 33,400. 23 lakh 33,400. 23 lakh 33,400. Now below that small a record small b. Below that small a, present value of cash inflow, record small b, less present value of cash outflow. Less present value of cash outflow. How much is the amount you are spending today? Today initial cost is 20 lakhs. So 20 lakhs into 1. Within bracket, in respect of the next to the present value of cash outflow, within bracket 20 lakhs into 1. 20 lakhs into 1. So in respect of outer amount column, record 20 lakhs within bracket. Present value of cash outflow, outer amount column, record 20 lakhs within bracket. So now outer amount column, total it. 23 lakh 33,400 minus 20 lakhs. You are getting 3,33,400. Underline it. Amount column, total it 3,33,400. In respect of the 3,33,400, record NPV, that is net present value. In respect of the 3,33,400, record net present value, that is small c. Small c, net present value. So now we have found what is the NPV for project 1, project 2. Now for project 3 we should find. Project 3 we are going back to the normal NPV calculation. That is for all 5 years there are different cash inflows. So you should multiply it with the present value factor at the rate of 15%. They have given for project 3 it is 15%. So 15% present value factor for all the each year you should multiply it and you should add summation of that is present value of cash inflow. So below that statement number 3. Below that statement number 3. Calculation of NPV of project 3. Calculation of NPV of project 3. NPV of project 3. Year. Below that 4 columnar table. First column year. Second column CFAT. Third column present value factor. And fourth column present value. Year, CFAT, PV factor and present value. So in respect of years, record what is the number of years? 5 years. So here 1, 2, 3, 4, 5. In respect of year column, record 1, 2, 3, 4, 5. Now copy the CFAT for each year. See, they have given different CFAT for all 5 years for the project 3. So for first year it is 10 lakhs. Copy it under CFAT column. For year 1 it is 10 lakhs. For year 2 8 lakhs. For year 3 6 lakh. And for year 4 2 lakh. Year 5 1 lakh. CFAT is 10 lakh, 8 lakh, 6 lakh, 2 lakh and 1 lakh. So that is the CFAT for all 5 years. So what is the discounted rate of return? 15%. So PV factor at the rate of 15% for all 5 years you should calculate what is the values. So here we can use the calculator and calculate what is the PV factor. What is the percentage? 15%. So how to calculate PV factor is 1 divided by 1.15. That is 1 divided by 1 plus interest, that is discounted rate percentage. So 1 divided by 1.15. You are getting for first year 0.869, that is 87. So for the in respect of first year PV factor, record 0.87. And if you replace equal to once, you will get what is for second year. For second year it is 0.756. 0.756 in respect of year 2. And if you press equal to again, you will get for the third year, that is 0.658. 0.658. And again if you press equal to, you will get for fourth year, that is 0.7572. 0.572. And if you press equal to again, you will get 0.497, that is for the fifth year. 0.497. So we have calculated what is the present value factor at the rate of 15% for all 5 years. So if you multiply the CFAT with the present value factors, you will get what is the present value. So multiply it. CFAT into PV factor, you will get present values. So 10 lakh into 0.870, you are getting 8,70,000 for year 1. In respect of year 1, present value is 8,70,000. So year 2 calculate 8 lakh into what is the present value factor? 0.756. You are getting 6,04,800. So in respect of present value, record for year 2 6,04,800. 6,04,800. Now for year 3, 6 lakh into 0.657. 6 lakh into 0.657. You are getting 3,94,200. So in respect of year 3, record 3,94,200. 3,94,200. There will be some small changes because points like decimal points we are rounding off to the third digit. So if you are not rounding off, like if you are rounding off with different values, then you will get different present value factor, present values. Only there will be some little difference, like 100 rupees, 50 rupees will be the difference. So here for year 3 it is 3,94,200, and for year 4 2 lakh into 0.572, 2 lakh into 0.572, you are getting 1,14,400, 1,14,400. Below that, year 5 1 lakh into 0.497, 1 lakh into 0.497, you are getting 49,700, you are getting 49,700. Now total it. Now total all the net present values, total all the present values: 8,70,000, 6,04,800, 3,94,200, 1,14,400, 49,700, 49,700. You are getting 20,33,200, 20,33,100, 20,33,100. In respect of total it 20,33,100. In respect of the 20,33,100 record, therefore present value of cash inflow. Therefore present value of cash inflow. So we have calculated what is the present value of cash inflow. From that, if you deduct present value of cash outflow, you will get NPV. So below that record, small, below that record less present value of cash outflow. Present value of cash outflow. So in respect of present value column, record 20 lakhs within bracket. In respect of present value column, record 20 lakhs within bracket. So 20 lakhs minus 20 lakhs, 33,700 minus 20 lakhs. You are getting 33,100. So total it, present value column, total it, you are getting 33,100. 33,100. So in respect of the 33,100, record NPV, that is net present value of project 3. NPV. See, when you compare all three NPVs, that is NPV of project 1 is 1,06,000, and NPV of project 2 is 3,33,400, and NPV of project 3 is 33,100. So you are getting more NPV, that is NPV is higher under project 2. So that project should be acceptable. So below that record comment, NPV of project 2, NPV of project 2 is comparatively higher. Hence it is advisable to select project 2. So with that, we have completed problem number 16. They asked us which project is acceptable. So we have calculated an NPV technique, and we have calculated different NPVs. Comparing all the NPVs, project 2 NPV is higher, so that project is acceptable. That is the solution for problem number 16. So next, moving on to problem number 15. Important problem. Moving on to problem number 15. Okay. See, problem number 15, what they have given. A company is considering the purchase of stapler manufacturing machine. Okay, there is a company, X company, it is considering for purchase of stapler manufacturing machine. It is going to purchase a machine for stapler, that to manufacture that they are going to procure a machine. Two mutually exclusive machine A and B are being evaluated. So there are two machines that is mutually exclusive, A and B. It is being evaluated. Relevant information is given below. See, for both the machines, relevant information they have given. So the company is planning to purchase stapler manufacturing machine, and it is having two options, that is machine A and machine B. So they have given what are the different details of both machines. So under particulars, they have given machine A and machine B. So first, cost of the machine. Machine A is 10 lakhs, machine B is 15 lakhs. Life is same, that is 5 years, 5 years. So you can evaluate it using NPV also. So next is salvage value for machine A is 20,000, machine B is 30,000, which is nothing but at the end of 5th year, when you are selling the scrap, that is old machine, you are going to get 20,000 as resale value, and for 40,000 for machine B as resale value. Next is cost of production per stapler, excluding depreciation, is 30 rupees and 28 rupees. So excluding depreciation is nothing but it is a production total cost which does not include depreciation. So if you add depreciation to it, you will get total cost. If you deduct that from the total revenue, you will get what is the PBT. Below that, they have given other information. The stapler can be sold at 40 each. So 1 unit can be sold at 40 each. Depreciation is based on cost net residual value over the life of the machine on straight line basis. That is, cost is 10 lakhs minus residual value is 20,000. You are getting 9,80,000 divided by what is the remaining life of the machine, that is 5. So 9,80,000 divided by 5 is the depreciation for machine A, that is 1,96,000. For machine B, 15 lakh minus 40,000 divided by 5. 15 lakhs minus 40,000 divided by 5. You are getting 2,92,000 is the depreciation. So that we have calculated. Then assume that taxes and operating cash flows occur at the end of the year, and that salvage value is also taxed at the end of the 5th year. See, you should assume that all the income that is being received, all our operating cash flows are happening at the end of the year. So, and the salvage value are also received at the end of the 5th year. So you are selling the machine at the end of the 5th year and receiving the amount at the end of the 5th year. So assume 50% tax rate and 12% discount rate. So tax rate is 50% and that is cost of capital, that is NPV, present value factor, should be taken at 12%. And present value factors with decimal places as given. See, they have given the decimal places, that is 0.893. They itself have mentioned what is the present value factors at the rate of 12%. So you should use this present value factors only. Below that, present your calculation up to the nearest rupee. Production volume is 1 lakh. So total production volume is 1 lakh per year. You are required to evaluate the proposals using NPV method, because both the machines are having same life. You can evaluate using NPV method, showing the discounted cash flows for each machine and advice for the financial perspective of the choice of the suitable alternative. Same concept. You should do NPV. First, you should calculate what is revenue. You should deduct total cost. You will get PBT. You should deduct tax. You will get PAT. On that, add what is the depreciation. You will get CFAT. On that CFAT, multiply it with the annuity factor. That is, for every year it is same. That is, for every year the revenue is same and CFAT will be same. So if you multiply it with the annuity factor of PV factor, annuity factor at the rate of 12% for 5 years, you will get what is the present value of cash inflow. From that, if you deduct present value of cash outflow, you will get what is the NPV for both the projects. As simple as that. Okay. So first we should calculate one by one. First we should calculate what is the present value of annual CFAT, that is cash inflow. So first, see man, understand properly. There are two cash inflows. One is annual CFAT. Every year you are going to receive income, that is cash inflow. One more cash inflow is this residual salvage value is there, no, 20,000 and 40,000. That is also considered as cash inflow at the end of the 5th year, because you are selling the machine, you are going to receive cash. There is a cash inflow. So at the end of the 5th year, there is a cash inflow, that is called present value of scrap value. So present value of salvage value is nothing but it is also a cash inflow. Cash outflow is only one, that is total cost of production is the cash outflow. You can also calculate, that is cost outflow is only cost of machine, that is 10 lakh and 15 lakh. So below that, first we should calculate what is the present value of annual CFAT, then present value of cash outflow, then add present value of annual CFAT and the present value of scrap value, then deduct the present value of cash outflow. You will get what is the NPV for both the machines. So below that, problem number, record problem number 15. Problem number 15, statement number 1. Statement number 1. Calculation of present value of annual CFAT. Calculation of present value of annual CFAT. Present value of annual CFAT. So, see, you are going to calculate annual CFAT and you are going to multiply that CFAT into annuity factor at the rate of 12% for 5 years. Then you will get what is the present value of CFAT, annual CFAT. So below that 3 columnar table, first column particulars, second column machine A and third column machine B. First column particulars, second column machine A and third column machine B. First we should calculate what is the contribution, then deduct the depreciation, you will get what is the PBT, from the tax, then you will get PAT, on that add depreciation you will get CFAT. That is the procedure which we follow from all the for cost of, when we are doing capital structure also we are doing the same method. So first, under particulars, small a, selling price per unit. Selling price per unit. The staplers can be sold at 40 each. So that is the selling price. So under both the column record 40. Machine A also 40, machine B also 40. Selling price per unit 40. Below that small b, less cost of production per stapler excluding depreciation. See, depreciation is nothing but fixed cost. Excluding depreciation means we are considering everything as a variable cost. So record small b less variable cost per unit. Less variable cost per unit. If you reduce variable cost from the sales price, you'll get contribution per unit. So variable cost per unit, how much they have given for machine A, it is 30, machine B 28. So record machine A 30 within bracket, machine A 30 within bracket, and machine B 28 within bracket. Machine B 28 within bracket. Below that small c, contribution per unit. Contribution per unit. Within bracket A minus B. Within bracket A minus B. Now total it 40 minus 30, you are getting machine A 10. For machine A 10 rupees, and for machine B 40 minus 28, you are getting 12 rupees. 10 rupees and 12 rupees. Below that small d, see, contribution per unit we found. If you multiply that contribution per unit into total number of units, you will get what is the total contribution. From the total contribution, if you take off depreciation, you will get what is the profit before tax. So total contribution, from that you will deduct fixed cost, so that you will get what is the net profit. So here fixed cost is only one is there, that is depreciation. So you should deduct depreciation. So below that small d, below that contribution per unit, record small d, total number of units sold. Total number of units sold. Here they have given production volume is 1 lakh units annually. So under both the columns record 1 lakh. Under both the columns, machine A also 1 lakh, machine B also 1 lakh. Machine A 1 lakh, machine B also 1 lakh. Below that small e, total contribution. Therefore total contribution within bracket C into D. Total contribution within bracket C into D. So 10 into 1 lakh in respect of machine A record 10 lakhs. Machine A record 10 lakhs. And machine B 12 into 1 lakh, you are getting 12 lakhs. 12 into 1 lakh, you are getting 12 lakhs. So total contribution is 10 lakh for machine A, and machine B is 12 lakhs. From the total contribution, deduct depreciation. Below that small f, less depreciation. Less depreciation within bracket. Depreciation within bracket. For machine A, what is the depreciation? 10 lakhs minus 20,000 divided by 5. So within bracket, in respect of machine A, next to that machine A record 9 lakh 80,000 divided by 5. 10 lakh minus 20,000 is nothing but 9 lakh 80. So in respect of depreciation record 9 lakh 80,000 divided by 5 within bracket. So machine A column record 1 lakh 96,000. 1 lakh 96,000 within bracket. 1 lakh 96,000 within bracket. Next to that, in the gap between machine A and machine B record within bracket, how much is the calculation for depreciation for machine B? 15 lakhs minus 40,000 divided by 5. That is 14 lakh 60,000 divided by 5. Within bracket record 14 lakh 60,000 divided by 5. 14 lakh 60,000 divided by 5. In respect of machine B column, record 2 lakh 92,000 within bracket. 2 lakh 92,000 within bracket. 2 lakh 92,000 within bracket. So now total contribution, if you deduct depreciation, you will get profit before tax. It is nothing but contribution less fixed cost. You will get what is net profit. Here depreciation is the only fixed cost that is available. So contribution less depreciation, you will get what is the net profit, that is before tax. So now below that small g, therefore PBT, that is profit before tax. Now underline it. In respect of that PBT, now total it. 10 lakhs minus 1 lakh 96,000, you are getting 8 lakh 4,000. In respect of machine A record 8 lakh 4,000. And for machine B calculated 12 lakhs minus 2 lakh 92,000, that is 9 lakh 8,000. That is 9 lakh 8,000. So profit before tax for machine A is 8 lakh 4,000 and machine B is 9 lakh 8,000. So that is profit before tax. If you take off tax from that, you will get profit after tax. So below that small h, less tax at the rate of, what is the tax percentage they have given? 50%. Less tax at the rate of 50%. Tax at the rate of 50%. Now calculate for both the column. 8 lakh 4,000 is the profit before tax. On that 50% is the tax amount. So 8 lakh 4,000 into 50%. How much you are getting? 4 lakh 2,000. 4 lakh 2,000 within bracket. In respect of tax at the rate of 50%, machine A record 4 lakh 2,000 within bracket. And for machine B, 9 lakh 8,000 into 50%. 9 lakh 8,000 into 50%, you are getting 4 lakh 54,000. You are getting 4 lakh 54,000. Within bracket 4 lakh 54,000. So now both the columns total it. 8,04,000 minus 4,02,000, you are getting 4,02,000. Below that record 4,02,000, and 9,08,000 minus 4,54,000. Underline it, record below that 4,54,000. 4,54,000. So in respect of this 4,02,000 and 4,54,000, record small I PAT, that is profit after tax. Profit after tax. So to this profit after tax, if you add depreciation, you will get CFAT. So that is the requirement. That is CFAT into annuity factor. CFAT, if you multiply it with the discounted factor, you will get what is the present value. So first we need CFAT. For that, PAT plus depreciation is CFAT. So below that, record small j, add depreciation. Add depreciation below that PAT, that is profit after tax, record add depreciation. See how much is the depreciation we calculated in the small f? 1,96,000, 2,92,000. So take this amount to depreciation here. In respect of the small j, that is depreciation, add depreciation, record 1,96,000 in respect of machine A and 2,92,000 under machine B. 1,96,000 for machine A, 2,92,000 for machine B. So profit after tax plus depreciation, you will get CFAT. So below, now total it. Below that small k, CFAT, therefore CFAT within bracket I plus j, within bracket I plus j, that is PAT plus depreciation is the CFAT. Because depreciation is the non-operating, non-cash expenses. So depreciation you didn't expend and all, like you didn't spend any amount on depreciation, like you didn't give cash on depreciation. You just, it is a depreciation is the portion of machine value which has been appropriate to the amortized to the particular year. So it is not an, it is a non-cash expense. So when you are adding back the non-cash expense, you will get what is the total cash inflow during the year. So below that, in respect of the CFAT, record underline it and record 4 lakh plus 1,96,000, you are getting 4,02,000 plus 1,96,000, you are getting 5,98,000. 5,98,000. And in respect of machine B, 4,54,000 plus 2,92,000, you are getting, how much you are getting? You are getting 7,46,000. 7,46,000. So that is the annual CFAT. So here CFAT for every year, that is for all 5 years, is same. So if you multiply, when there is same CFAT for all the 5 years, you can multiply it with the annuity factor at the rate of percentage they have given, what is 12% for 5 years, so that you will get what is the present value of CFAT. If there is different present value, that is if there is different CFATs, then you will get present value by normally calculating the NPV method. That is, you should prepare a tabular column and multiply the CFAT with the present value factor, so that you will get present value. Whereas when CFAT is same for all the 5 years, you can directly multiply it with the annuity factor at the rate of given percentage for the number of years, so that you will get present value of cash inflow directly. So here CFAT is 5,98,000 and 7,46,000. So below that small l, annuity factor, you should multiply the CFAT with the annuity factor. So record small l annuity factor at the rate of 12%, because they have given discounted rate is 12%. So at the rate of 12% for 5 years. So life of the machinery is 5 years, for 5 years. Small l annuity factor at the rate of 12% for 5 years. So now just calculate what is the annuity factor for 12% for 5 years. You can just see the annuity table. You can see the annuity table. %12 for 5 years. Here 12% for 5 years, it is 3.605. So it is the annuity factor. So you should multiply the CFAT with this 3.605. So record in respect of annuity factor at the rate of 12% for 5 years, under both the columns record 3.605, because for both the columns discounted rate is 12% and life of machinery is 5 years. So under both the column record 3.605. Under machine A 3.605 and machine B also 3.605. Now below that small m, present value of CFAT, within bracket K into L, within bracket K into L, within bracket K into L. Now multiply it. Now underline it and total it. How much is the value? CFAT into annuity factor, that is 5,98,000 into 3.605. 5,98,000 into 3.605. You are getting 21,55,790. In respect of machine A, column record. Below that annuity factor 3.605 record, underline it. 21,55,790. 21,55,790. And for machine B, calculated 7,46,000 into 3.605. Now underline it. How much is the amount? 7,46,000 into 3.605. You are getting 26,89,330. 26,89,330. So in respect of that 21,55,790 and 26,89,330, record small m, present value of cash, CFAT, present value of cash flow after tax, that is CFAT. So done. With that we have calculated what is the present value of annual CFAT. Now next what we should calculate is present value of cash outflow, which we know that present value of cash outflow is 10 lakh under machine A and 15 lakh under machine B. And then we should also calculate what is the present value of scrap value, that is cash inflow which you are getting at the end of 5th year under both the missions. So next column, next put the heading, next statement. Statement number 2, calculation of NPV. Statement number 2, calculation of NPV. This is also repeated question in exam. Similar kind of question has been constantly repeated in every other attempt. Suppose in June they ask, December they won't ask, again in June they will ask. So this is how they are doing for this particular method of like mission A and mission B. Those kinds of problem, very easy problem. If you work out for 2-3 times, you will understand it. You can do it even if they give any other method also, like whether if they change the numbers also, you can easily do it. So work it out at least for 2 or 3 times. So statement number 2, calculation of NPV. Below the 3 columnar table. First column particulars, second column mission A, third column mission B. First column particulars, second column mission A, third column mission B. Below that particulars record small a, present value of CFAT. Present value of CFAT, which we calculated in the previous statement. That is under mission A record 21,55,790, 21,55,790, and under mission B record 26,89,330, 26,89,330. That is the present value of CFAT. So apart from this cash inflow, you are also getting salvage value. That is at the end of the 5th year, you are getting for machine. If you purchase machine A, you are getting 20,000 as income, cash inflow at the end of 5th year. That is salvage value. And if you purchase machine B, you are getting 40,000 as return, like at the end of 5th year. So this is also cash inflow. So below that small b, below that small a, record small b, present value of scrap. Present value of scrap. Come to the machine A. Below that value, that is below that present value of scrap, record in respect of machine A column itself, record below that value, present value of scrap, below that line record how much is the present value. 20,000 you are going to receive at the end of 5th year for 12%. At the end of 5th year, 12% how much? 0.567. So that is the present value factor. So below that record 20,000 into 0.567. 20,000 into 0.567. You are getting 11,340. So in respect of present value of scrap, above that line record 11,340. 11,340. For machine B record. For machine B, same like that. Leave one line. Below that line record how much is the salvage value? 40,000 at the end of 5 years. So 5th year, how much is the value for present value factor? 0.567. So open a bracket, 40,000 into 0.567. 40,000 into 0.567. How much you are getting? You are getting 22,680. So above that line record, in respect of present value of scrap record, 22,680. 22,680. So these are the different cash inflows. So now total it. Now total machine A and machine B. Underline it and total machine A and machine B. Mission A 21 lakh 55,790 plus 11 lakh 340. Sorry, 11,340. 11,340. You are getting 21 lakh 67,130. 21 lakh 67,130. And for mission B, 26 lakh 89,330. 26 lakh 89,330 plus 22,680. Plus 22,680, you are getting 27 lakh 12,010. 27 lakh 12,010. So in respect, we have calculated total of cash inflow, present value of cash inflow, that is present value of CFAT plus present value of scrap is the total amount of cash inflow which has been converted into present values. So in respect of A is 21 lakh 67,130, in respect of B is 27 lakh 12,010. So in respect of that values, particulars column record small c present value of cash inflow. Small c present value of cash inflow. Below that small d less present value of cash outflow. Small d less present value of cash outflow. So how much is the cash outflow they are doing? Under mission A 10 lakh, under mission B 15 lakh, that is been expended on the first day, that is year 0 itself. So small d less present value of cash outflow. Mission A column record 10 lakhs within bracket. Mission A column record 10 lakhs within bracket, and mission B column record 15 lakhs within bracket. Mission B column record 15 lakhs within bracket. So mission A 10 lakhs within bracket and mission B 15 lakhs within bracket. So now total it. Now mission A column total it 21 lakh 67,130 minus 10 lakhs, you are getting 11 lakh 67,130. 11 lakh 67,130. Underline it, 11 lakh 67,130. And for mission B also total it 27 lakh 12,010. 27 lakhs 12,010 minus 15 lakhs. Minus 15 lakhs. You are getting 12 lakh 12,010. 12 lakh 12,010. So these values are nothing but this is the net present value, because present value of cash inflow minus present value of cash outflow will get what is NPV, that is net present value. So in respect of those values record therefore net present value, NPV, net present value. So comparatively project B is having higher net present value compared to project A. So project B should be accepted. So below that record comment. Below that record comment. Net present value of mission B. Net present value of mission B is comparatively higher. And hence it is advisable to accept mission B. Comparatively higher, and hence it is advisable to accept mission B. See, here in this sum, in this particular problem number 15, there is no life disparity, that is both are 5 years. So we are doing it using net present value. But also if they give different years also, here they are given, do you feel the NPV would be the ideal measure in the case of to take decision, they have asked. See, you are required to evaluate the proposal using NPV method they have given. So if they give any number of years, if this is 10 years and this is 5 years, also you should calculate NPV and you should give a comment on that, whether which project is acceptable using the NPV value. Whereas again they have asked, do you feel NPV would be the ideal measure in the case to take the decision? Then you should tell there is no life disparity, so NPV will be the right capital budgeting technique in order to evaluate the projects. That is the comment which you should give. So below that record one more comment. Below that record one more comment. In the given problem or in the given case, there is no difference in life in years. There is no difference in life of the projects. There is no difference in life of the projects, comma, hence it is appropriate to evaluate the projects using net present value method. Hence it is appropriate to evaluate the projects using net present value, NPV method. So that is the comment which you should give for this particular question, that is, do you feel the NPV would be the ideal measure in the case to take the decision? Because there is no life disparity, it is ideal to evaluate using NPV. So with that we have finished problem number 15. So problem number 15 is also over. So moving on to problem number 1. Moving on to problem number 1. See, they have given the directors of Beta Limited are contemplating the purchase of new machine to replace a machine which has been in operation in factory for last 5 years. So they are going to replace new machine, that is old machine, with the new machine. Ignoring interest but considering tax at the rate of 50% on net earnings, suggest which of the two alternatives should be preferred. The following are the details. That is, whether to go with the old machinery, to purchase new machinery, or to purchase old machinery. Okay, that is the question they have given. Tax rate is 50%. Life of the factory lasts for 5 years. That is, for next 5 years, which machine to use? That is the evaluation which they are asking. So they are given in particular purchase price, estimated life of machine 10 years, 10 years, machine running hours per annum 2000 and 2000 both, units produced per hour is 24 and 36, wages per running hour is 3 and 5.25, power per annum is 2000 and 4500. Then consumable stores per annum is 6,000 and 7,500, and all other charges per annum 8,000 and 9,000. Material cost per unit is 0.5 and 0.5. Selling price per unit is 1.25 and 1.25. These are the different data which they are given for old machine and the new machine. So you may assume that the above information regarding sales and the cost of sales will hold good throughout the economic life of each of the machine. That is, for every year the CFAT will be the same, which is the point they are mentioning here. Next, depreciation has to be charged according to straight line method. So whatever the purchase price of the machinery divided by estimated life of machinery, that is 10 years, you will get what is the total depreciation per annum. So you should evaluate both the machine, that is old machine and the new machine. So here we can use NPV method because 10 years for both the options. Problem number 1. See, you can either use NPV or you can use ARR also, because accounting rate of return is also a traditional technique. Here I have a doubt whether we can use NPV or ARR. They didn't mention what to use. See, the directors of Beta Limited are contemplating the purchase of new machine to replace the machine which has been in operation in factory for last 5 years. You may assume the above information regarding to cost of sales and will hold good throughout the economic life of each machine. Depreciation has to be charged according to the straight line method. So in this particular problem, they have used ARR to calculate because we are doing so much of sum using NPV. So for all the exam problems, we have did only using NPV. So in this particular problem, we are doing using ARR. And also one more thing is, you should keenly observe that there is no cost of capital which has been given. If you see the question problem number 1, there is no return on investment or ROI or cost of capital percentage which they didn't mention anything in this particular problem number 1. Only tax percentage they have given. So when there is no cost of capital or percentage, you cannot calculate PV factors. So we are using ARR to evaluate these projects. Okay, using this all the data, we should calculate what is the which is the best option. So come to the notes. Put the heading problem number 1. Problem number 1. Statement number 1, calculation of ARR. Statement number 1, calculation of ARR, which is accounting rate of return. Calculation of ARR. Below that, capital A, calculation of annual CFAT. Calculation of annual CFAT. For ARR, PAT is enough. Whereas here they have calculated, change it into calculation of PAT itself. Calculation of profit after tax. It is not annual CFAT, calculation of PAT. Below the 3 columnar table, first column particulars, second column old machine, and third column new machine. First column particulars, second column old machine, and third column new machine. Below that particulars, small a, Sales value per annum. Sales value per annum. Small a, sales value per annum. So using this, we can easily calculate what is sales value per annum. What are the different data they have given? They have given selling price per unit, and also they have given units running per hour, that is units produced per hour, and they have given machine hours running per hour. So machine running hours per annum is 2000 and units per hour is 24. So 24 into 2000 is the total number of units produced into 1.25 is the selling price. So you will get what is the sales value. So calculate it. Under sales value per annum, record small room number 1, running hours per annum. Running hours, that is how many hours machine is running per annum. Running hours per annum. Old machine can run up to 2000 hours. New machine also 2000 hours. So running hours is 2000. Running hours is 2000 and 2000. Below that, small room number 2, units of production per hour. See how many units they are producing per hour? 24. Total hours running per annum is 2000. Per hour you are producing 24. If you multiply this both, you will get what is the total production. So below that, small room number 2, units of production per hour. Both the column record. First column, old machine column, how much they have given? Units produced per hour is 24 and new machine 36. So record under old machine record 24 hours, 24 units per hour. Under new machine record 36 units per hour. 36 units per hour. And below that, small room number 3, annual production. Annual production. Annual production. Under old machine record, small room number 3, annual production within bracket small room number 1 into small room number 2. Small room number 1 into small room number 2. Record. Under old machine 2000 into 24. 2000 into 24 you are getting 48. And under new machine 2000 into 36 you are getting 72,000. 2000 into 24 old machine you are getting 48,000 and new machine 2000 into 36 you are getting 72,000. So annual production is 72,000. Below that, small room number 4, selling price per unit. Small room number 4, selling price per unit. So what they have given selling price per unit? 1.25 under both the options. So both the options record 1.25. Old machine also 1.25, new machine also 1.25. So if you multiply the total production with the selling price per unit, you will get what is the annual sales value. So below that, small room number 5, annual sales value. Annual sales value within brackets Roman number 3, small Roman number 3 into small Roman number 4. So how much is the value under old machine? 48,000 into 1.25. 48,000 into 1.25. In respect of annual sales value, old machine record 60,000. Record 60,000. And under new machine 72,000 into 1.25. 72,000 into 1.25. You are getting 90,000. Under new machine column record 90,000. 90,000. So that is the annual sales value. From that, if you deduct cost, you will get PBT. So below that, leave a line gap, record small b, total cost. Small b, total cost, underline it. Small b, total cost and underline it. Below that, what are the different costs given here? Wages cost, power per annum, consumable stores per annum, all other charges, material cost. These all 5 are different costs. Apart from this, you will also have depreciation cost, because depreciation is also form part of cost of production, total cost. So below that, small Roman number 1, wages per running hour is 3 rupees. So total number of running hours is 2000. So 2000 into 3 is the total wages cost per annum. So in respect of wages, next to old machine record within bracket 2000 into 3. 2000 into 3. Left hand side of the old machine record 2000 into 3, 6,000 rupees. 6,000 rupees. And between the old machine and the new machine within bracket, for the new machine, how much is the wages per running hour? 5.25. So 2000 into 5.25. Within bracket 2000 into 5.25, you are getting 10,500. So in respect of new machine, wages cost is 10,500. Because they have given wages per running hour, you should multiply wages per running hour into total number of running hours per annum, so that you will get what is the wages per annum. So below that, small Roman number 2, record one by one. Power, record small Roman number 2, power cost. Old machine 2000 and new machine 4,500. Old machine 2000 and new machine 2,500. Next is consumable stores. Small Roman number 3, consumable store cost. Consumable stores cost. Old machine 6,000 and new machine 7,500. Under old machine column record 6,000. and under new mission column record 7,500. Below that, small room number 4, other charges. Other charges, under old mission column record 8,000 and under new mission column record 9,000. So these are the direct costs which they have given. So power, consumable stores and other charges. Next, small room number 5, material cost. Material cost. See, material cost they have given per unit. So 0.5 into total number of units annual production is 48,000. We should multiply this 48,000 into this material cost per unit. You will get what is the total material cost. So in respect of old machine, left hand side of the old machine record within bracket 48,000 into 0.05, 48,000 into 0.50 within bracket. Calculate it. 48,000 into 0.50, how much you are getting? 24,000. In respect of old machine record 24,000. Material cost in respect of old machine is 24,000. In between old machine and the new machine within bracket record, how much is the total number of units produced for new machine? 72,000. So material cost per unit is 0.5. So within bracket 72,000 into 0.5. 72,000 into 0.5, you are getting 36,000. In respect of new machine, material cost is 36,000. 36,000. Okay. Now below that, small room number 6. These are the total cost, direct, that is cash expenses. Apart from that, depreciation is also included in the total cost. So how much is the depreciation? See, they have told that estimated life of machine is 10 years. Okay. And cost of sales, see, they have given directly that estimated life of machine is 10 years. So you should divide the cost of purchase price divided by 10 years, you will get what is the depreciation. So below that, small Roman number 6, depreciation per annum. Depreciation per annum. How much is it? Depreciation for old machine 40,000 divided by 10, you are getting 4,000. So in respect of old machine record 4,000, and for new machine 60,000 divided by 10, you are getting 6,000. For new machine, under new machine column record depreciation is 6,000, 4,000 and 6,000. 4,000 and 6,000. Now total cost, total all the costs. 6,000 under old machine 6,000 plus 2,000 plus 6,000 plus 8,000 plus 24,000 plus 4,000. Total it using calculator. Total it, you are getting 50,000. You are getting 50,000. And new machine also total it. Total all the costs. 10,500 plus 4,500 plus 7,500, 7,500 plus 9,000 plus 36,000 plus 6,000. You are getting 73,500. 73,500. So with that we have calculated what is total cost. Now below that small c, PBT, profit before tax, within bracket record A minus B. A minus B. Within bracket record A minus B. In respect of old machine column, A minus B in respect of old machine column record 60,000 minus 50,000, you are getting 10,000. 60,000 minus 50,000, you are getting 10,000. And new machine 90,000 minus 73,500, you are getting 16,500. So profit before taxes, old machine is 10,000, new machine is 16,500. Below that small d, below that profit before tax record small d, less tax at the rate of 50%. They are given tax rate is 50%. So tax at the rate of 50%. So in respect of old machine, how much is the tax? 10,000 into 50%, you are getting 5,000. So 5,000 within bracket. In respect of tax, record 5,000 within bracket for old machine. And for new machine, 16,500 into 50%, you are getting 8,250. Within bracket, record 8,250. So now total it. Old machine column total it 10,000 minus 5,000. Below that record 5,000. And 16,500 minus 8,250 record. Underline it and record 8,250. So in respect of 5,000 and 8,250 record profit after tax. Small e, profit after tax, within bracket C minus D. Profit before tax minus tax, you will get profit after tax. Profit after tax. So with that we have calculated what is profit after tax. What else we need? We need what is the average investment. We can also go with initial investment so that we'll get ARR. So below that capital B, next statement capital B. Calculation of ARR. Calculation of ARR, that is accounting rate of return. Calculation of ARR. Below the 3 columnar table, first column particulars, second column old machine, and third column new machine. Particulars, old machine, and new machine. Below that particulars, record small a, average PAT or annual PAT, annual profit after tax. Old machine column record 5,000, new machine column record 8,250, which we calculated in the previous sum. Profit after tax is 5,000 and 8,250. Below that record small b, original investment. Original investment, old machine record 40,000. So they have given purchase prices 40,000 and 60,000. 40,000 and new machine 60,000. New machine 60,000. Below that small c, ARR. ARR, that is accounting rate of return, ARR. Within bracket A divided by B into 100. A divided by B into 100. So calculate it. 5,000 divided by 40,000 into 100. You are getting 12.5%. So in respect of old machine record 12.5%. And calculate for new machine. 8,250 divided by 60,000 into 100. You are getting 13.75%. In respect of new machine record 13.75%. So that is the accounting rate of return for both the machines. That is old machine 12.5, new machine 13.75. So under new machine, your accounting rate of return is higher. So it should be acceptable. Below that record comment. ARR of new machinery. ARR of new machinery is comparatively higher. And hence it is advisable. To purchase the new machinery. And replace the old machinery. Okay, done. With this, we have completed problem number 1. Okay, so we have done some nearly 10 to 12 problems. So remaining problems, there are few problems which I am going to mark it in institute material. So for the answers, you can refer the institute material, but then I'll just explain you the concept in the sum. I'll explain you what they have asked in the sum. You just have to use your institute material for the answers. For problem number, I'll just tell you which are all the problems which you should refer. Problem number 2, 3, and 4, and 5. So for all these problems, I'll just refer you the institute material. So you can use that institute material to solve the second problem, third problem, fourth problem, and fifth problem. So all these are age-old problems. That is second, third, fourth, and fifth. All these are very old problems. So basically, we are focusing on exam problems where we are not focusing on the repeated age-old problems. So that the second, third, fourth, and fifth problems you can refer the institute material. You just mark in the institute material. If you have institute material, just open it. See, for this problem number 2, 3, 4, and 5, I'll just make one more video. Okay, I'll just explain you the concept because we are referring to institute material for these problems. Okay, in institute material, the format will be not that much user friendly. Like if you are using institute material, you won't understand the format of that institute material problems. Whereas compared to our own method of solving the problems, institute material will be little. It will be little hard to get why they have deducted, why they have added. So I'll just make a small video of problem number 2, 3, 4, and 5. We'll just refer to the institute material. I'll just tell the page number of the problems. That is, I think so, illustration 10, 11, 12, and 13. That is the 2, 3, 4, 5 in capital budgeting. So that all 4 problems, I'll just make one more video and I'll just solve it in that particular video itself. So with this, we have completed this problem number 1. So we'll just solve the other problems in the next video. Thank you.